Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hi, this is Yazad. Some time ago, Union Minister of Road Transport and Highways, Nitin Gadkari, announced that all vehicles in India will soon be able to run on ethanol. He had previously issued an advisory to car makers to introduce flexible fuel, that's petrol combined with methanol or ethanol, engines and vehicles within the next 6 months. Now, flexible fuel or flex fuel is claimed as less pollutant compared to petrol because of its biofuel nature. Since petrol costs more than ethanol, people will be able to save more as well. Auto companies such as TVS Motors and Bajaj Auto have already started manufacturing flex fuel engines for their two-wheelers and three-wheelers. Now, since ethanol production is critical to achieving this goal, many companies are working towards catering to the potential increase in demand. The formula is pretty simple. Whoever has higher capacity will benefit the most. Here are the top 4 ethanol stocks to add to your watch list for 2022. First up, Praj Industries Ltd. First on our list is Praj Industries Ltd. Praj Industries is an engineering company that provides end-to-end solutions in bioenergy, process technology, and wastewater treatment technology. The company is the undisputed market leader in the domestic ethanol plant installation and equipment business and the domestic breweries installation segment. Its market position is supported by its global presence with over 750 references in more than 70 countries. Currently, Praj is executing India's first second-generation ethanol plant for Indian Oil at its Panipat facility. It has also inked an MOU with the company to set up biofuel production facilities, including CBG, biodiesel, and ethanol. Both companies will work together to facilitate the sales and marketing of various co-products and intermediates produced from these facilities. Recently, Praj has announced the launch of its patented technology, which would allow the preservation of sugarcane juice for 12 months. Now, this technology will allow sugar mills to produce ethanol around the year. For the December 2021 quarter, the company reported a net profit of Rs 700 million as compared to 281 million rupees in the same quarter last year. Revenue from operations jumped sharply by over 67% during the quarter to Rs 5.9 billion as against Rs 3.53 billion in the December 2020 quarter. The stock has had a fantastic run on the bourses and has risen from around just Rs 125 to as high as Rs 448 recently. Since then, it has corrected a bit and is currently trading at levels close to 400. The next ethanol stock on our list is Shree Renuka Sugars Ltd. The company is an agribusiness and bioenergy company that is engaged in the business of sugar manufacturing, refining, trading, and ethanol generation. It also provides turnkey distillery, ethanol, and certain sugar process equipment and biofuel plant solutions through its subsidiary KBK Chem Engineering. Shree Renuka Sugars distilleries manufacture portable-grade alcohol and fuel-grade ethanol that can be blended with petrol. In June 2021, the company announced that it will invest Rs 4.5 billion to expand its ethanol capacity from 970 kiloliter per day to 1,400 kiloliter per day to meet untapped demand. In February 2021, the board had approved capacity expansion from 720 kiloliters to 970 kiloliters per day. Post the debt restructuring exercise and the subsequent open offer, the company is now a subsidiary of Wilmar International Limited. Wilmar International is one of the largest global processors and merchandisers of palm oils. Shree Renuka Sugars posted a net loss of 978 million rupees during the September 2021 quarter on lower income and higher finance costs. It had posted a net profit of Rs 1.1 billion in the corresponding quarter of the previous fiscal. After touching its 52-week high in July 2021 at Rs 47.75, the stock has been trading lower over the last few months in the range of Rs 30 to 35. Next up, we have Dwarikesh Sugar Industries Ltd. The company is engaged in the business of sugar, cogeneration of power, and industrial alcohol. It operates under the brand name Bunki. Sugar accounts for 80% of the total revenue, while power accounts for 13%. The distillery business accounts for the remaining 7%. The company has 3 manufacturing facilities located in the state of UP. In July 2021, Dwarikesh Sugar announced it would set up a 175 kiloliter per day distillery at its Dham unit in Bareilly, Uttar Pradesh. The company's existing distillery capacity is 162.5 kiloliters per day, with existing capacity utilization being approximately 90%. It expects to complete the project within 15 to 16 months. The project cost is Rs 2.3 billion, of which Rs 1.9 billion would be via bank finance and the remaining 464 million rupees would be via internal accruals. This expansion in capacity is expected to drive revenue in 2022. Further, higher sucrose diversion towards B-heavy molasses juice-based ethanol is expected to moderate its inventory levels and lower its working capital borrowing. For the December 2021 quarter, Dwarikesh Sugar reported a 286% growth in net profit at Rs 288 million. The company's net profit stood at Rs 74.7 million during the same period last year. The stock has gained steadily throughout the last year and is currently trading close to its 52-week high. The last stock on our list is Balrampur Chini Mills Ltd. The company is one of the largest integrated sugar companies in India. The allied businesses of the company comprise distillery operations and cogeneration of power. The sugar business accounts for 82% of the company's revenues, followed by the distillery business 10% and cogen power business 8%. It entered the distillery business in 1996 and has commissioned 4 distilleries to date. Its 4 distillery units operate at a capacity of 520 kiloliters per day. They are primarily engaged in the production of industrial alcohol and ethanol. Over the years, Balrampur Chini has grown its capacity by expansion projects and acquisitions. In January last year, the company invested close to 2 billion rupees to scale up its distillery business. It is set to invest another 4 billion rupees during the current fiscal to enhance its distillery capacity from 520 to 840 kiloliters per day. This will be done by adding another 320 kiloliters per day at its Maizapur plant in Uttar Pradesh. The capacity should become operational in 22-23 ethanol season. The management of the company said it expects close to 30% of its revenues to come from the distillery business over the next 3 years. For the December 21 quarter, Balrampur Chini reported a decline in its net profit at Rs 641 million against Rs 831 million in the September 2021 quarter. Over the last 12 months, the stock has risen from a low of Rs 157 to as high as Rs 459. So why should ethanol stocks be a part of your portfolio? A recent report by the International Energy Agency said that India is set to become the 3rd largest market for ethanol in the world after the US and Brazil by 2026. This comes as no surprise as ethanol demand in India tripled to an estimated 3 billion litres between 2017 and 2021. While government policies were the principal drivers of this demand, factors such as overall transport fuel demand, costs, and specific policy design also drove sales. Going forward, the increase in demand for ethanol is expected to continue. Prime Minister Narendra Modi in June last year announced that the government has resolved to meet the target of 20% ethanol blending in petrol by 2025. Earlier, the target was set for 2030. The government has already directed oil CPSEs, that is Central Public Sector Enterprises, to set up second-generation ethanol biorefineries in different parts of the country to meet its target. It has also lowered the goods and services tax on ethanol meant for blending with gasoline from 18% to 5% as it looks to curb dependence on imported fuels. While the above-mentioned reasons are compelling, one must view ethanol stocks with the same amount of caution as one would view other stocks. Ethanol stocks are vulnerable to the cyclical nature of the sugar industry and agroclimatic risks related to cane production. Further, their profitability remains vulnerable to the policies of the government, domestic and international trade, and pricing. Now, if you plan to invest, assess the fundamentals and prospects of the business. Sustained research must not be compromised despite the positive odds. Now, that's all we have for this week. Thank you very much for watching. Happy investing. Goodbye.